Goldman Sachs, they think gold could go considerably higher than $4,900 because of this. These things are creating this domino effect of de-dollarization, de-treasurization. They acquired 40 tons of gold in the London OTC market, the over-the-counter market. It's the second largest monthly purchase in a couple of years. Higher inflation, higher yields, lower bond prices, less demand. What we're in essence we're seeing is yield curve control, whether they want to call it that or not. By telling Japan not to sell treasuries, you're capping the yields. By coming in and buying the back end, you're suppressing the yield. We're not seeing the true effects of inflation measured by the CPI. This is the Cantillon effect, where the wealthy get wealthier because they take that money right away and they buy assets that go up in this inflationary environment. Rich get richer, the poor get poorer. If you're going to cap rates, if you're going to continue to push money through the system and cap rates, which is the pressure release valve, when you pump money into the system, the way that the pressure is released is through higher rates. Stocks will probably go much higher in an inflationary world that we live in, but measured in gold ounces, I think gold will. Well, that's exactly why Goldman Sachs just came out a couple days ago and said that their $4,900 gold target is not a ceiling, it's their base case. They said that that was their originally they came out and said that, but they said now the headline says Goldman sees significant upside risk to that number. In plain English, they think gold could go considerably higher than $4,900 because of this, because money is moving into gold as confidence in the dollar, and more importantly, the U.S. fiscal situation is being questioned. And I think that's what this is all about. It's just the fact that you can tell a lie over and over and over and over again, but the reality begins to show through. And I think the reality is finally showing through. Never in my lifetime that I can remember anyway, have I seen a situation where the United States and its policies are questioned quite the way that they are globally. And I think that's going to have some effects. And, maybe if our policies, take our policies aside, I could argue that what he's doing on a policy level actually makes this country better. It certainly isn't creating a lot of friends, but you could argue it's actually that's a debate for another time. But what I am saying is, along with that, the fiscal irresponsibility, the overt manipulation, the sanctions, which, he calls them tariffs. Many of them are masquerading as sanctions or masquerading as tariffs, but they're really sanctions. These things are creating this domino effect of de-dollarization, de-treasurization, if it were a word, gold accumulation, because the lack of trust in a system that's based on trust has effects, and some of those effects begin to grow exponentially the more and more we see this intervention.
Goldman Sachs is raising its gold target while the world questions the dollar's foundations. Andy Schectman notes that the $4,900 target matters because capital is responding to credibility, sanctions, and declining trust. That combination can accelerate dollar diversification and gold accumulation through feedback loops. For savers, purchasing power risk becomes harder to ignore when policy intervention replaces confidence. Next, Andy Schectman exposes the institutional behavior, making this gold move far less speculative than it appears.
And that's why you're seeing countries like China who are buying way more gold than they say. They acquired 40 tons of gold in the London OTC market, the over-the-counter market. It's the second largest monthly purchase in a couple of years, but it's being reported by the World Gold Council that's 167% more than the official 15 tons they reported for June. This is just for the month of June. And so also they acquired 48 tons through the OTC market in May. That's 380% above the 10 tons they officially reported. So they continue to increase their gold accumulation, but they're buying far more than the official data shows. And so I think that this is the same thing that we heard about the central banks, that they said they bought 16 tons in the first quarter, and the World Gold Council said, no, you didn't. You bought 244 tons, 15 times what you said. The big money doesn't want the world to know that they don't trust the system anymore, so they're quietly accumulating gold, shedding treasuries, doing so very, very quietly through the over-the-counter market, lying about the numbers, being caught on it, because if if it became very obvious that this is a rush to protect themselves from what they see as ultimately, higher inflation, higher yields, lower bond prices, less demand, it would be a rush through a revolving door. But you can see it through their actions that they're just looking for alternatives, and I think that's the bigger issue altogether.
It's remarkable that we're seeing this right now, and it is all of these data points are lining up. You're seeing both the loss of confidence by international holders in the bond and a divestiture of the dollar into other asset classes that can't be sanctioned against them, and then you're seeing this clandestine major record move, even though it's big enough that you can't hide it.
China's reported gold buying may be only a fraction of its market activity. According to Andy Schectman, the bigger signal is the gap between official purchases and OTC accumulation, with 40 tons estimated in June versus 15 officially reported. That discrepancy suggests institutions may be positioning quietly ahead of broader recognition. For investors, the danger is arriving late after the repricing begins. Next, Andy Schectman reveals why this hidden accumulation could become impossible to conceal.
It's really the elephant in the room. You keep telling us about record month after month after month and quarter after quarter, and yet there's a definite concerted effort to make this not turn into a stampede, because then the jig's up for everyone. Can you talk to us about how that affects ordinary individuals, just ordinary American middle class people who've worked and saved all their lives and are trying to get by in retirement? They're following the same playbook where all the big guys are now off quietly and determinedly following a new playbook.
Well, I think the bigger issue is, how does this all play out? If we, what we're in essence we're seeing is yield curve control, whether they want to call it that or not. By telling Japan not to sell treasuries, you're capping the yields. By coming in and buying the back end, you're suppressing the yields. And when you suppress the yields at the same time you let money creation, look at M2, it's going straight off the chart. Money creation is the definition of inflation. We have been conditioned into believing it's rising prices. The consumer price index, CPI, rising CPI, is the symptom of higher inflation. It is not inflation. Inflation is inflating the money supply. When you increase M2, you're inflating. Now, the problem is what M2 or that increase in money supply, a lot of that money has gone into financial assets, which is not calculated by the CPI. And so we're not seeing the true effects of inflation measured by the CPI the way that we should. This is the Cantillon effect, where the wealthy get wealthier because they take that money right away and they buy assets that go up in this inflationary environment. The rich get richer, the poor get poorer, because the poor have to face the inflation that is pummeling into the system in the face of rising prices of staples that you need every day: food, tuition, insurance, healthcare. All that stuff is going higher, and very little of it is actually identified in the CPI.
The biggest inflation threat may be what official inflation statistics fail to capture. What Andy Schectman is highlighting is the connection between suppressed yields, expanding M2, and asset inflation that benefits those already invested. When new money enters financial assets first, retirees holding cash can lose purchasing power without seeing the full damage reflected in CPI. Next, Andy Schectman unravels how yield suppression quietly transfers wealth while policymakers claim inflation is under control.
And so you have a situation right now where if you're going to cap rates, if you're going to continue to push money through the system and cap rates, which is the pressure release valve, when you pump money into the system, the way that the pressure is released is through higher rates. Because if you're going to inflate the money, you need higher rates to attract buyers of our debt. Well, why would I buy your debt if you keep inflating it? I need a higher rate to compensate for that. But if you cap those rates, this is again suppressing Mother Nature, then it has to blow off somehow, and it does so in the form of price inflation. And you will see things get much more expensive. And this is why the wealthy people continue to buy assets. They will appreciate. But the things that we need for everyday living will go up commensurate, but it won't bother the people who are making lots of money in their investment portfolio. It will kill a lot of people who are just barely getting by. It's awful, and it will increase. And I think that's the biggest issue here, is that if you want to survive this, it's not even about profiting. I mean, you could in the right situation, but it's more along the lines of holding assets, whatever those assets mean to you. I don't want people to think that, yeah, you got to buy gold and silver, it's the only thing you can own, because I don't really believe that. I think it might be the best things that you can own, but assets in general will appreciate in an inflationary world. And I think when you're trying to think which asset should I own, think in terms of liquidity. What is your liquidity need? And, you could own great real estate that appreciates, but you have very poor liquidity. You could own stocks, and they'll probably appreciate very well in an inflationary capacity that we are in. Forget about how overvalued the stock market is, and forget about perhaps it's going to crash. Forget about all that.
Capping yields does not eliminate inflation. It decides where the damage appears first. Andy Schectman's argument suggests suppressed rates can force monetary pressure into consumer prices, while asset owners gain protection. That creates a dangerous divide between people whose portfolios absorb inflation and retirees whose expenses simply rise. For savers, liquidity and real assets become defensive tools rather than speculative bets. Next, Andy Schectman exposes why the safest looking bond strategy could become the source of the next purchasing power shock.
Stocks will probably go much higher in an inflationary world that we live in, but measured in gold ounces, I think gold will massively outperform the stock market over the next couple of years. And so measure your assets in gold ounces to see how they're doing, and you'll see very quickly that that gold and silver probably perform a lot better than most people think. They're not just the tortoise that everyone thinks they are. They sniff out the fiscal irresponsibility, and it's being front run right now. These markets are by sophisticated investors who understand it. So the moral of the story, the answer to your question, save in assets, period. Best you can. And even if it's just a little bit every paycheck, even if it were an ounce of silver or a tiny bit of Bitcoin or whatever it is to you, that's the way to survive and maybe even thrive in this environment that I believe will become much more costly in terms of inflation and the irresponsibility that our fiscal policy has, coupled with the yield curve control / lack of demand for long-dated treasuries. All of this is getting kind of serious, I think, and this is now more than ever the time to hold assets.
The other thing you were a little bit, I think, too generous about was saying that the reason we're not seeing as much of the monetary inflation showing up in consumer price index is because they doesn't measure financial assets. Okay, true enough. But what about all the substitutions that have gone into the consumer price index to artificially make that number lower, but even more insidiously, the physical things that are happening with real assets to hide the impact, such as draining the strategic petroleum reserve almost dry to what some are saying is getting to be dangerous levels. What about importing Argentinian beef to cover up the fact that people are not going to be able to afford American beef? Can you talk to us about these many-fold ways that are being used to hide and hide and hide the real impacts that people are going to feel?
A rising stock market can still represent a loss when measured against gold. This is where Andy Schectman's thesis shifts. Investors may mistake nominal gains for genuine wealth preservation, while fiscal deterioration quietly erodes purchasing power. The critical comparison is not stocks versus cash, but assets versus gold ounces over time. For long-term savers, that changes what performance actually means. Next, Andy Schectman exposes the hidden adjustments that can make official inflation look safer than household reality.
Well, that's just it. I mean, Chris Powell from GATA, we all owe Chris and Bill Murphy a debt of gratitude, all of us in this industry and who own gold and silver, for their tireless pursuit of free markets. But he said there are no free markets anymore, just interventions, just manipulations. And that is true. And hiding the reality of much higher energy costs through bleeding dry the strategic petroleum reserve to the lowest level in 40 years. And that's not a good thing. It's supposed to be there for an emergency, to doing things like you're saying, to bringing beef up from Venezuela. And of course, they're doing the same thing with their gold and with their oil. And I think that, this is creating behind the scenes, I think, the lack of demand for U.S. Treasuries, because people are seeing these interventions, they're seeing what they're doing, and they're understanding, and at the highest level they see it. They see it before the public does, and they understand that this is not what the world reserve currency, this is not what the center of free trade, that's not how you would behave if all was normal. And so these things will catch up. When you talk about price inflation, in the form of much higher energy costs, in and of itself, there's normally a 6-month lag time. Well, if things are still not normal, even close to normal in the Strait, and you have masked all of this and bled down the strategic petroleum reserve, by the second half of this year, which we are fast approaching, we're already there. By the fourth quarter, let's say, projections are for much higher energy costs as this works its way through the system. And now we don't have the cushion to bleed that out any longer, or we'll completely bleed it dry. So yeah, these things will show themselves. And maybe this is yet to come. I think it is, because that lag effect coupled with the suppression efforts, they're running out of ways to mask reality. So these are the reasons not only you're seeing the world divest of treasuries and dollars, but it's also, I think, why you're seeing big sophisticated money. I want to grab something right here.
The most dangerous inflation may be the kind policymakers can temporarily disguise. Andy Schectman notes that energy reserves, substitutions, and market interventions can delay visible price pressure without removing it. A 6-month energy lag means today's apparent stability may already contain tomorrow's shock, while sophisticated investors position ahead. For households, delayed inflation is still inflation, and preparation becomes harder once costs accelerate. Next, Andy Schectman reveals why the disappearing buffers behind official stability may matter more than today's headline numbers.
Front run what is happening in the gold market. And over the last 3 weeks, speculators bought $22 billion worth of gold futures. That's the largest amount in over a decade in terms of speculation into this market. And it's not just the speculators. Gold ETFs are seeing strong inflows, hedge funds are increasing exposure, and central banks continue to buy. That's all very true. But the largest amount in over a decade in the last 3 weeks, because I think the big money sees that we're running out of options. And the more that we continue to do this, spin doctor and not let Mother Nature do what she wants to do, like telling Japan, no, you can't really find price discovery. We can't allow that to happen. The more reality is going to ultimately set in, and that is that, the Fed does not have more power than the free market. And the free market ultimately will decide the fate of the Treasury, the fate of the dollar. I guess we will see, but for me, I'd much rather sit on the sidelines than something outside the dollar. And that's why I think owning assets is the only way to get by this. It's the only way to survive. It's not even about profiting right now as much as it is preservation of your lifestyle and of your purchasing power.
Gold's futures market just recorded a buying surge that most savers may overlook. What Andy Schectman is highlighting is the $22 billion speculative inflow over 3 weeks, alongside ETF and central bank demand, suggesting institutions are preparing before consensus catches up. The crucial issue is whether intervention can suppress price discovery indefinitely when capital keeps moving toward protection. For investors, preservation may matter more than chasing returns.